Hey gang, good morning. I get asked all the time about how what's going to happen with interest rates now in 2022 with inflation on the rise, talks of a recession. What's going to happen with real estate interest rates? And so I put together a quick 5 to 10 minute little video presentation here to give you our take on what we expect to happen in the market. So we're really going to look at three dynamics here that are impacting residential mortgage rates, investor rates, owner-occupied rates, that sort of thing. One is inflation. Number two, the effect of the Fed hikes that they've started doing and telegraphed that they're going to be hiking again multiple times this year. And the balance sheet runoff, the Fed has been buying quite a few mortgage-backed securities and Treasury notes. And they signaled that they are going to, or they have stopped doing that, and they're going to start selling those off. So what is the effect of the balance sheet runoff? And what about this recession that everyone seems to be talking about in the financial press? So a little bit of history here of the Fed and their response and their influence in the market, the mortgage market in particular. So you go back to the 70s with Arthur Burns when he was the Fed chairman. He saw inflation go from 7 to 14%, and mortgage rates went from 12 to 18% in that time period. Well, Paul Volcker was brought in to break the back of inflation, to get a handle on that. A situation was just running out of control. So he came in about a 2-year period of time, raised the Fed funds rate from 11% to 20%. And inflation responded positively over that time. The inflation dropped from 14% to 5%. And mortgage rates, which were at an all-time high of 18%, saw a drop all the way down to 12%. So it's kind of counterintuitive when you hear all over the news that, hey, the Fed's gonna hike the rate. Most people think interest rates, they think mortgage rates, they think long-term rates. But the reality is it's really the short-term interest rates that they're hiking to try to get a handle on inflation. You see that did happen in the 70s. One of the consequences, though, was that we did move into a recession and the stock market sold off quite a bit. And we're now in Greenspan. We saw inflation move from 1.75% to 3.5%. We saw mortgage rates at the same time go from 7 to 8.5%. And as a response to that, Greenspan and the Fed raised their funds rate from 4.75 to about 6.5% over the course of about a year. And that did serve to break the back of inflation. And you saw the response where inflation came down from 3.5 to 1%. And mortgage rates correspondingly dropped from 8.5 to 5.5%. So inflation up, Fed comes in and raises their short-term interest rate, which puts the brakes on the economy, slows things down, takes some of the heat out of the system. And as a result, long-term interest rates start going down. And the reason is because inflation and long-term rates are arch enemies. Think about it this way. If you had $10,000 and you're going to invest today and you want to return, well, if you're only investing it for a year, you sort of know you're not going to get much of a return on that money. Think passbook savings, money market, that sort of thing. But if you're going to tie that money up for 10 or 15 or 20 or 30 years, then you expect that you're going to get a return on that money over time. Otherwise, you're going to put the money somewhere else. And so when inflation is running out of control, people think that the long-term rates, hey, if inflation today is 8, 9%, then I should be getting 8, 9, 10% on my long-term investments at a minimum just to stay up with inflation. And so by jacking up those short-term rates to get a handle and to start cooling the economy and cooling inflation, then those long-term interest rates start coming down. Now, again, the consequence of that was the stock market was down 50%. We had a recession. Well, here we are today. So we have Jerome Powell here. He's the Fed chairman. We've seen inflation go from 1.5% to a blistering 8.5%. Actually, the number just came in today for the month of June, and it's over 9%. It's crazy. We've seen mortgage rates go from around 2.5% to they hit about 6%. And the Fed started bumping the rates. They just bumped the rate 75 basis points or 3/4 of a point about a month ago in June. And interestingly enough, the long-term interest rates, it kind of peaked at that point around 6%. And since then, they've started backing down to the mid-5s and potentially to the lower 5s. So, no crystal ball, but if history is a teacher, that it does repeat itself, as we all know, following the same trend as the Fed aggressively raises the funds rate, and they're going to go again another 75 to 100 basis points in the month of July, and then maybe another 50 to 75 in September. They're aggressively going out, hitting the brakes hard on the economy to bring that inflation number down. And as a result, we should expect to see that come down. We should expect to see interest rates come down as well. In addition to that, there was a major supply shock to the system with COVID, where we had inventory shortages, supply chain issues, and all kinds of craziness going on there as everyone was at home. They were getting extra money from the government bailout funds, and they stopped going out and pursuing services. They didn't travel. They didn't go to restaurants. They didn't stay overnight in hotels. But what they did was they ordered on Amazon en masse, and that created major shipping issues. In fact, shipping container costs went up from around $2,000 to ship a container across the ocean full of stuff here for us to buy to over or right at $20,000 a container. So that was a massive increase. And you remember the stories about all the ships docked off of Long Beach in California, waiting weeks and weeks and weeks to deliver their cargo. Just amazing issues. Well, a lot of that stuff is sort of playing out in the system right now. And in fact, just the recent report was the cost to ship a container now has dropped back down to about $8,000. So that's significantly lower. Although it's higher than where it started pre-COVID, it's significantly lower than where it was just a year ago. And you start to hear Walmart and Target both came out with reports about a month ago or so saying that they're carrying a lot of inventory. And so all those orders that they placed a year and a half, 2 years ago, a year ago are now starting to finally show up. So that's also going to have a negative effect on prices, which will bring inflation down. So we expect that that we're going to see that decline. Probably the fourth quarter of this year, we will probably still see hot inflation numbers through the summer. But when we turn into the fourth quarter, compared to last year, plus the influence of the Fed increases, you're going to see a decline in mortgage rates. What does that mean to the stock market? Well, we've seen the stock market sell off quite a bit already. There could be more room to the downside there. Let's take a look at the impact that Fed rate hikes and runoff of the balance sheet has impacted the mortgage interest rates, the long-term rates. And if we go all the way back to around 2016, the Fed did a rate hike right at the end, December of 2015, a 25 basis points or a quarter of a point hike. And after that hike, you saw the interest rates decline. Well, as interest rates started to go back up, the Fed hiked again in October of 2017. You saw a small decline. They hiked again. We saw another decline in April, and they hiked again here and we saw another decline all the way down here to about October of 2017. This is when the Fed said, hey, we've got all these bonds and mortgage-backed securities on our balance sheet. We're going to stop buying them. We're going to start selling them off. And the bond market reacted in a negative way, got fearful. They're like, oh my gosh, they're going to start selling. They're going to flood the market with all these bonds. And so the bond market started demanding higher interest rates. And so you see, as they do the runoff, even though the Fed hikes here, the interest rates are going up. The Fed hikes again in April of 2018. We see a small improvement, but yet still hasn't quite taken effect from this runoff. You can see sort of the trend all the way up to here. The Fed hikes again. Okay, there's a little bit of an improvement, kind of sideways, all the way until about October of 2019 or 2018. They do one more rate hike. And then now you start to see finally the increase in the funds rate, the rate hikes starts to affect the negative or the long-term interest rates in the curve, and those rates start to come down. And then you see they announce that they're going to start slowing down the runoff off the balance sheet. So the momentum accelerates. They stop completely selling off the balance sheet. And we have a major sell-off here, which is a reduction in interest rates significantly down to the October of 2019 period. So it's counterintuitive, but when the Fed raises the funds rate, we see, and it may take a little bit of time, but we see the long end of the yield curve or the 10 to 30-year interest rates start to come down. So you hear a lot in the news today about the inverted yield curve, and is that a signal of recession? And it has been a very predictable signal. We'll show that in just a minute. But basically, when they talk about the inversion of the yield curve, they're talking about the 10-year Treasury note versus the 2-year. And you would think, again, the longer the maturity on the bond, the higher the interest rate you're going to have. So again, you tie your money up for 2 years, you're going to get some return. But if you tie it for 10, that's a long time. So you should expect to get a better return. Well, if we dial back here to March, April of 2021, you see the spread, the difference was about 1.5 points. So the yield curve was really nowhere near inverted. But as we passed through the last year, year and a half or whatever, all the way until April this year, we saw the first inversion, which meant that the 2-year interest rate was higher than the 10-year interest rate. So we kind of flipped like that, or inverted. And now we're in early July. The yield curve has been heavily inverted for the last week, which is a signal of a recession to come. And it's not just the 2-year Treasury yield that has passed the 10-year. Now we see the 1-year, the 2-year, the 5-year, and the 10-year all, or the 1-year, 2-year, 5-year, 7-year have all inverted past the 10-year. So it's a pretty significant indicator. And if you look, again, historically, these inversions in the yield curve, what does that cause? Well, we see recession. So when you see this chart in red, every time we go in red, we're inverted. Then you see a recession of 1980. We sort of stayed inverted, the continued recession there. We go out into the early 90s. You see yield curve inversion, recession. Early 2000s, yield curve inversion, recession. Again, 2006, 2007, yield curve inversion, recession. And that a lot of this was precipitated by the housing bubble, which we'll talk about in a minute. We had a small inversion here in 2020 and then a recession. So how does unemployment affect recessions? I mean, there are other indicators other than the negative yield curve that sort of trigger and let us know that we're heading into sort of a recessionary environment. And one of them is pretty telltale. It's that unemployment rate. You hear in the news all the time, again, unemployment is at the lowest point, in history. And so you think, well, gosh, how in the world can that be recessionary? Well, it's when the unemployment rate starts to turn and sort of stop at the bottom point and start to turn up is a recession indicator. Let's look at some history. So the chart of unemployment rate here in white. So you'll see as the unemployment rate here sort of hit its lowest, and back in the 40s, once it hit the lowest, the rate shot up. We had a recession. Okay, in the 50s, same thing. Unemployment kept coming down. Lowest point starts turning up, recession. Lowest point, recession. Lowest point here, recession. We could look at here in the 70s, unemployment all the way down to the lowest point. It starts to turn up. We go into a recession. Same thing here in 74. Unemployment comes down, lowest point, starts turning up, recession. And again, you can track this all the way out here. 07, lowest point, turns up, major recession. And we had a small one in 2020. So basically a combination of the yield curve inversion plus the trigger of unemployment rate hitting its lowest and then starting to turn up are two heavy indicators of a recession coming into probably the fourth quarter of this year, maybe the first quarter of next year. And some people would argue we're in it right now. And you got to think the logic is real simple. If you're an employer, business owner, entrepreneur, you have employees, and you feel like the economy might turn, it might slow down. You're not sure if you maybe need all the staff you have. You might be concerned about future orders. You're looking to cut expenses anywhere where you can. And you might at that point be looking at some of the positions that aren't really necessary or haven't really been that effective, or maybe we're just over capacity issues when things are going really well. And now you're sort of pulling things in tight to make sure that you can ride through the recessionary period and then hire on the other side of that. So that's when we see the unemployment start to tick up pretty aggressively. And that's another indicator of recession. So again, how do recessionary periods impact mortgage rates and long-term rates? So interestingly enough, you can see here again in the dark segments are the recessionary periods. And you can see every time we've hit a recessionary period, mortgage interest rates have gone down. Rates up here in 1980, recessionary period, mortgage rates fell. Rates up here in 1990, recession, they fell. Same thing down here in 2022, 2008, boom. Same thing in 2020. So generally speaking, when the economy cools and interest rates come down, We have a historical trend for that. Let's see here. You can see some of the figures as they blow up. Very significant changes over time. Okay, so what about housing during recessions? People tend to think, hey, prices are going down, houses are going down, the economy's slowing down. What's the truth? The reality is, when you look at the Case-Shiller National Home Price Index back from the 60s all the way to today, literally every time we went through recession, the housing market either held on or improved every single time, with one exception, and this was the housing bubble of 07. And the housing bubble of 07 was actually the cause of the recession, not the result of the recession, or Great Recession, or depression, as some people will call it. And you got to think about it. Back in 04, 05, 06, 07, anybody who fogged a mirror could get a mortgage. They had to put, very little, if no money down. They had low credit scores. They didn't have to have a job. They didn't have to prove employment or income or anything, and they could get a mortgage. And so you had way too many people getting loans that weren't qualified for it. When you see here around 2011, 2012, things turned the corner. We started going up. Well, when they, on the back end of that 07 debacle, they passed new legislation, the Dodd-Frank Act, and a number of other acts to basically really, really curtail who could get a loan and who couldn't. And from that point forward, everyone who's had a home mortgage is highly qualified for it, been highly qualified for it. So if you look here also, housing supply, another issue that we've got going on into our market right now is supply. Like in 07, we had 3.7 million homes that were available for sale in the market. And today we have around 870,000 to 900,000. So we have a tremendously less inventory than we had back then, which, again, it's a supply and demand issue. If there's not much supply, then we look at the next slide and say, okay, look at the number of households. So in 2007, when we had 3.7 million homes available, we only had 116 million households. Today, we have 870,000 homes of supply available, but 129 million households. So we have 14 million more households and almost 3 million fewer homes, which bodes very, very well for the housing market to stabilize. Now, we're not going to see, 18 and 20% rates of appreciation like we've seen over the last couple of years, but we will see 3 to 4 to 5 to 6% appreciation, particularly in those areas of the country that people are moving to. Maybe not some of the areas are moving from the big cities and the overregulated areas. So that's it for just a quick analysis of inflation, interest rates, and the housing market and where we see it. This is mid-2022. It's been a fun ride. It's going to be even more fun in the fall into next year. A lot of great things are happening in this market. And if you have any questions, please feel free to reach out, give me a call, book a time. We'd love to help you with whatever goals and needs you have.